Hey guys, I've had a lot of confusion about velocity banking and really the benefits of doing it and the chunking methodology that it promotes. So what I did was I actually created a spreadsheet that has 3 different scenarios in it. And what I want to do is walk through that with you and kind of talk with you about the conclusions and the bottom line that I came up with. So the first scenario is a straight amortization schedule of 30 years of paying down a $100,000 mortgage at 3.25%. The second scenario is the same payment terms, except there's an extra payment of $1,000 a month that you would make. The third scenario is the same payment terms, but rather than making a straight $1,000 payment a month, what you do is you chunk $10,000 from a line of credit or a credit card, paying down the mortgage, and then you pay down the line of credit or credit card $1,000 a month until that's brought back down to zero. And then you chunk another $10,000 into the mortgage. Now, there are several conclusions that I came out of this with. The first one is whether you do extra payments or chunking, paying off the loan sooner certainly saves money. That's kind of a no-duh kind of thing. The second thing, though, is with chunking, there's definitely a risk to chunking that you take on. It really assumes that the unforeseen won't happen. So, for instance, what if you lose your job? Or what if there are unforeseen expenses that you might have? If you're left mid-chunk, meaning you've only paid down a couple of months on your line of credit or credit card, that could be devastating to your finances because that money just sits there at that high rate of interest. And if you never have the opportunity to pay that completely down, that could absolutely be devastating to you, let alone the fact that if you have to default on the credit card, it would crush your credit rating. So here's the bottom line on this. Number one is chunking is cheaper than not making any extra payments at all. I'll give you that. However, when you compare chunking to just making an extra payment, chunking is not better than just making an extra loan payment. It's less risky to make the extra loan payment, and it just doesn't make sense to be able to incur that extra risk that you would have with chunking and being left, like I said, mid-chunk. Now, if you want to even look at the numbers more, right? I mean, if you just compare the interest paid between what you'd pay with extra interest versus what you'd pay with chunking, in this simple scenario where I have the 3.25% amortized loan, and then you're chunking from an 18% credit card, just looking at dollars purely, you're going to pay $5,400 more if you chunk versus doing an extra payment. Now, even if I brought that down to 9%, okay, you're still going to pay about $2,000 more. And the reality is just on a straight dollar-to-dollar comparison, the only way that you come out better is if your credit card or line of credit rate is going to be cheaper than your amortized loan interest rate, which frankly, I don't see that really ever happening, right? So putting it back at 18%, right, if you use a credit card, there's just no good reason to be chunking whatsoever. The other thing I would leave you with is you want to make sure that you've got, whether you use the chunking method or you do the extra $1,000 paying straight down to your mortgage, you want to make sure that you've got at least 6 months expenses saved first before you start doing that. Because once you make a payment into your mortgage or you start doing the chunking method, that money is gone and it's hard to get it back again. So you want to make sure you've got enough saved to protect yourself from the unforeseen. So hey, if you want to download this spreadsheet, and if you want to learn more, if you want to be able to play with this on your own, go to novelocitybanking.com, and that's where you'll be able to find the spreadsheet and you'll be able to get more information on this, okay? Thanks a lot, and we'll talk to you later.